In this video, we are going to analyze and value Baidu to understand why investing legends like Michael Burry and David Tepper are buying this company while its stock is down 26% in the last year. It's actually trading at prices we haven't seen since 2010. So, is this an undervalued opportunity or a value trap with too many geopolitical risks? Today we'll go through our 7-step analysis process to find out. Baidu is China's leading internet search engine and a major player in artificial intelligence. Beyond search, they are heavily invested in AI cloud services, video streaming, voice recognition, and self-driving technology. There are a lot of great things we could say about Baidu, but the market seems skeptical. So let's find out, are the potential gains worth the risk? If you invested $1,000 in this company 10 years ago, you bought 101 shares, and today they would be worth something close to $370. That's a loss of 63% over the last decade. Not exactly what we want to see in a long-term investment. The decline has been especially steep in the last year, with the stock dropping 26%. But sometimes the market overreacts, creating opportunities for those willing to look deeper. So let's start by looking at the ownership structure of this company. Individual insiders, that is a check. 19.7% of the company is owned by individual insiders, and almost all of these shares are owned by Robin Li, who is a co-founder of Baidu. That is some significant skin in the game, which means his interests should be aligned with shareholders. And are individual insiders buying? That is an X. We don't see any transactions from insiders recently. And do super investors own this company? That is a check with 3 super investors. And the most notable among them are Michael Burry, where Baidu makes up 13.6% of his portfolio, and David Tepper, for whom it represents 2% of his holdings. And are super investors buying right now? That is a check. Last quarter, David Tepper bought over 100,000 shares, increasing his position by 7.2%. So what might these super investors see in Baidu that others are missing? Let's examine its fundamentals. Return on invested capital, that is an X at 7.3% 10-year median returns. And we want to see this number higher than 10%, so that's disappointing. And what do we know about net profit margin? It is a check, averaging 13.7% over 5 years. Baidu currently has the 10th best net profit margin in the industry, so that is great, but it is nowhere near companies like Pinterest, Meta, Tencent, or Google. And now let's take a look at share buyback. It is a check. They bought back 1.2% of shares in the last 10 years. It's a small number, but at least they are not diluting shareholders. And the debt? It is an X. It would take 2.4 years to pay the long-term debt with a current free cash flow. We want to see it under 2 years, so they are close but not quite where we want them to be. Overall, Baidu's financial health is decent but not outstanding. Now let's see what their growth looks like. Revenue growth, that is an X at 8.7% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so that falls short of our expectations. Free cash flow growth, that is an X at 3.2% in the last 10 years. That's even worse. And earnings per share growth, that is an X at 4.1% in the last 10 years. These growth numbers are concerning. For a technology company focused on cutting-edge areas like AI, we would expect much stronger growth. Baidu does not currently pay any dividends. For a tech company reinvesting in growth initiatives like AI and autonomous driving, this isn't necessarily a negative. However, given the modest growth rates we've seen, shareholders might rightfully question whether the company could be returning some capital. Okay, so we know a bit about Baidu, but now it's time to value it. Price to earnings ratio is 7.6. That's incredibly low for a technology company. For comparison, many US tech giants trade at PE ratios of 20, 30, or even higher. This suggests that either there are significant risks ahead or the company is potentially undervalued. To calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And if you would like to know how to value companies by yourself using 4 most commonly used models, head over to stockinvesting.academy and explore our company valuation course. Okay, so first we have to estimate the growth of Baidu for the next 10 years. In the low scenario, we will estimate a growth of 3% for the entire 10 years. In the medium, 5%, and then 3%, and in the high scenario, 7% and then 5% growth. The low scenario is below the analysts' forecasts, which are around 4.8% growth. Medium is close to what analysts predict, and the high one is slightly below the historical revenue growth we saw in the last 10 years. So, with such estimates, the intrinsic value in the low scenario is $104, in the medium $114, and in the high scenario $133. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel comfortable. So with such a margin, we get in the low scenario $72, in the medium $79, and in the high one $93. And the current price is around $76. So it is almost all in the green. Only the low scenario with the margin of safety is lower than the current price. That suggests Baidu might be fairly valued or even slightly undervalued at current prices. So what does our analysis tell us about Baidu? On the positive side, the company has a strong competitive position in China as a dominant search engine. It has healthy profit margins, well above industry averages. There is a significant insider ownership, with the founder still holding nearly 20% of shares. Super investors like Michael Burry and David Tepper believe in this company, and the stock is trading at a very interesting price. But there are also significant concerns. Growth has been disappointing, at least for a technology company. Also, Baidu operates in a heavily regulated environment in China. And let's not forget that recent geopolitical tensions add significant risk. When we look at the company overview in our Stock Ranking Pro, which you can get access to by becoming a Patreon, we see a picture that is not great. Financial health is fine, nothing exceptional, but fine. Investor sentiment is great, but that's not a key factor here. We don't get any dividends, which wouldn't be a problem as long as we would have nice growth. But that's exactly the problem. For a company focused on cutting-edge technologies, such poor growth is very disturbing. It is a red flag. However, there are some positive things worth noting. Baidu is shifting from internet-centric to an AI-first business model. This transformation is evident in their focus on AI cloud, mobile ecosystems, and intelligent driving. Baidu is also scaling its domestic robotaxi operations, and it has entered into a strategic partnership with Dubai to introduce its driverless ride-sharing service. And that is marking its first step into a global autonomous driving market. So is Baidu a good investment at its current price? Well, it depends on your risk tolerance. The low valuation suggests that market has already priced in many of the risks we talked about, creating a potential opportunity. But this is definitely not an obvious bet. If you enjoyed this video, firstly, thank you for watching, and secondly, I'm pretty sure you are going to like my video about BYD, another Chinese company that has a potential of being a great investment. Thanks for watching and see you in the next one.